So when traders see the CME raising margins twice in 2 weeks during another historic silver rally, you can understand why alarm bells start ringing. The question being whispered in trading forums and on social media is not, will there be intervention? Is this the start of another forced deleveraging event? Here's what makes the current situation different from pure speculation. Unlike the rallies of 1980 and 2011, today's silver surge has fundamental supply dynamics supporting it. China, which controls between 60 and 70% of the global refined silver market, announced plans to introduce a silver export licensing system starting January 1st, 2026. That's literally 2 days ago. This new system will limit overseas sales to large, state-certified producers, effectively tightening the global supply of refined silver. COMEX inventories have reportedly fallen approximately 70% over the past 5 years. China's domestic silver stocks are near decade lows. At the same time, industrial demand continues to accelerate. Solar panel manufacturing, electric vehicles, AI chips, these technologies are consuming silver at unprecedented rates. Solar manufacturing alone now accounts for a significant portion of annual silver consumption worldwide. But there's a catch, and it's a big one. Analysts have calculated that if silver reaches $134 per ounce, operating profits across the entire global solar panel industry drop to zero. Over the past year, solar industry profits have already fallen from $31 billion to $16 billion as silver prices surged. At some point, high silver prices become self-limiting for industrial demand. We're also seeing a dangerous disconnect between paper and physical silver. The paper-to-physical ratio, meaning the amount of silver traded in futures contracts versus actual deliverable metal, reached an estimated 356 to 1 by late 2025. That's 356 ounces of paper silver traded for every single physical ounce. When you have that kind of leverage in the system, you have the ingredients for either a massive squeeze or a spectacular crash, depending on which way the momentum breaks. This brings us to what actually might happen on Monday. The CME calendar shows regular trading hours with no scheduled closures or special meetings. Monday, January 6th is a normal business day. Markets will open, contracts will trade, and life will go on. But normal doesn't mean calm. Here's what traders are actually worried about. Monday marks the first full trading week of 2026. Hedge funds are completing their year-end rebalancing. Commodity index adjustments are coming. The recent margin increases mean that some leveraged players are sitting on positions they may no longer be able to afford to hold. If silver experiences another violent price swing either up or down, we could see forced liquidations as traders hit their margin calls. Additionally, the macro environment is fragile. The Federal Reserve's path forward remains uncertain. Fed funds futures are pricing in approximately 2 quarter-point rate cuts for 2026, according to the CME FedWatch tool. But that's an assumption, not a guarantee. If inflation data surprises to the upside, or if the labor market weakens more than expected, that calculus changes rapidly. Silver, like gold, is sensitive to real interest rates and financial system stress. So why are people talking about emergency meetings and trading halts? Because market psychology is a strange thing. When you have a history of exchange intervention during previous silver peaks, when you see margin hikes accelerating just as prices hit historic levels, when you know that leverage in the system is extreme, the mind starts to prepare for worst-case scenarios. There's also the November 2025 outage still fresh in traders' memories. On November 28th, CME's Globex electronic trading platform experienced a 10-hour outage due to a cooling system malfunction at the Aurora, Illinois data center. Traders woke up unable to access futures contracts on the S&P 500, treasury bonds, crude oil, and precious metals. The disruption lasted 3 times longer than a similar technical failure in 2019. When your primary trading venue goes dark for 10 hours just a month ago, you start to wonder what else might go wrong. Let me be extremely clear about what we know and don't know. As of today, January 3rd, 2026, there are no official CME announcements of emergency meetings, no scheduled trading halts, no regulatory actions pending for Monday. The CME's official holiday calendar shows normal operations. The trading hours page lists standard Globex hours. There are no special advisories posted on the CME Global Command Center System alerts page. What we do have is a market sitting at an inflection point. Silver opened the year with regulatory changes in China, elevated margin requirements in the United States, record high prices followed by violent corrections, and a trader community that's watching every tick with heightened awareness. If Monday turns out to be just another trading day, the rumors will fade and people will move on. But if we see unusual volatility, if prices test key levels, if margin calls start cascading through the system, those rumors about emergency measures will resurface with renewed intensity. The real story here isn't about a specific emergency meeting or trading halt. The real story is about a market under stress, about the tension between paper contracts and physical metal, about the historical precedent of exchange intervention, and about how quickly sentiment can shift from greed to fear when everyone's playing with leverage. For traders, the lesson is simple. Know your risk, understand your margin requirements, and never assume that past patterns guarantee future outcomes. The CME has shown it will act to protect market integrity, even if that action causes pain for leveraged bulls. For everyone else watching from the sidelines, welcome to the world of commodity futures, where fortunes are made and lost in microseconds, where a cooling system failure can halt billions in trading volume, and where the line between market stabilization and intervention is thinner than most people realize. Monday will come. Markets will trade. And we'll all find out together whether these rumors had any substance, or were just another case of traders seeing ghosts in the machine. But one thing is for certain. When the CME moves margins twice in 2 weeks during a historic rally, people pay attention. And they should. Stay tuned, stay informed, and maybe, just maybe, take some profits off the table before heading into the unknown. Because in markets like these, being cautious isn't being bearish, it's being smart. Today is Friday, January 3rd, 2026, and the trading community is buzzing with speculation about what Monday might bring at the Chicago Mercantile Exchange. Let me be absolutely clear from the outset. There are no confirmed reports of any emergency CME meeting or planned trading halt for Monday, January 6th. However, the rumors themselves tell us something fascinating about market psychology and the real tensions brewing beneath the surface of precious metals trading. What we do have is something arguably more significant, a lingering anxiety from recent CME actions that has traders on edge as we head into the first full trading week of the new year. To understand why people are talking about emergency measures and trading halts, we need to rewind just a week and examine what actually happened. On December 29th, 2025, the CME implemented its second margin hike for silver futures in less than 2 weeks. The initial margin requirement for the March 2026 silver futures contract jumped to approximately $25,000, up from $20,000 earlier in December. For context, back on December 12th, that same requirement had been sitting at $22,000. In the span of 17 days, the CME increased the capital traders' need to hold silver positions by more than 13%. Now, if you're not a futures trader, you might be wondering why this matters. Let me paint you a picture. Imagine you're a trader who bought silver futures when margins were at $20,000. You put up that capital, and you're riding what's been an incredible rally. Silver hit a record above $84 per ounce in late December before crashing to near $70 in one of the largest intraday reversals in the metal's history. That's a $14 swing in a single session. For a standard COMEX silver futures contract covering 5,000 ounces, that translates to a $70,000 move in your position in just hours. The CME doesn't raise margins on a whim. These increases are designed to ensure market stability, to make certain that traders have enough capital to cover their positions during volatile swings. But here's where it gets interesting: the timing and the precedent. Crypto investor and macro analyst Kinba Frank posted on social media warning that the CME's actions are reviving memories of two of the most infamous moments in silver trading history. The first was 1980, when the Hunt brothers tried to corner the silver market. They accumulated over 200 million ounces using futures leverage, pushing prices close to $50 per ounce. The CME responded by introducing what became known as Silver Rule 7, which essentially eliminated leverage in silver trading. Combined with Federal Reserve Chairman Paul Volcker's aggressive interest rate hikes, this intervention crushed the rally and bankrupted the Hunt brothers. Silver collapsed, and the message was clear: the exchange would not tolerate what it viewed as market manipulation. Fast forward to 2011, silver surged from $8.50 to $50, fueled by zero interest rate policies, quantitative easing, and the European debt crisis. As prices peaked, the CME raised margin requirements 5 times in just 9 days. Leveraged funds were forced out of futures positions, and silver plummeted nearly 30% within weeks.